If you're paying a financial advisor a percent in fees, you're losing $400 Oz over 30 years, and they know it. But they'll never tell you. I'm Charlie Munger. I fired my financial advisor in 1965. I never hired another one again, not once in 60 years, and it made me billions. But here's what I discovered that most people never learn. Financial advisors aren't just unhelpful. They're actively destroying your wealth. In this video, I'm going to show you the exact math I used to prove this. You'll learn why 9% of people are better off VU professional advice. And you'll discover the simple strategy I followed that made me a billionaire. One that costs almost nothing and takes about 10 minutes per year. Fair warning. If you're currently paying someone to manage your money, what you're about to learn is going to sting. But that uncomfortable realization might be worth $400,000 to $100,000 to you. Let me start with the story that opened my eyes to this deception. Back in the early 1960s, I was a young attorney building my first investment portfolio. Like most people, I worked with a broker at a major Wall Street firm, a well-regarded professional from a prestigious company, highly recommended by my colleagues. This broker would call me regularly with stock tips, recommendations, ideas about what I should buy and sell. And like most people, I initially trusted him. He threw around sophisticated-sounding terminology. He had access to research reports I couldn't get. He appeared knowledgeable. So I followed his guidance for 2 years. I bought what he suggested, sold when he recommended, paid commissions on every transaction. After 2 years, my portfolio had gone essentially nowhere. It was up maybe 3 to 4% total, barely keeping pace with inflation, definitely underperforming the broader market. But then I did something most people never do. I calculated exactly how much I'd paid in fees over those 2 years, the total, over $7,000 in commissions. That was serious money in the 1960s, roughly equivalent to $70,000 in today's dollars. $7,000 for advice that had generated zero returns for me, but had generated guaranteed income for him. And that's when I grasped the fundamental flaw of the entire financial services business model. The deception isn't that financial advisors are evil people consciously trying to steal your money, though some certainly are. The deception is far more subtle and therefore far more dangerous. The deception is this, that their interests align with yours, that they profit when you profit, that they're on your team, that they're working for you. But the truth is the exact opposite. Financial advisors make money from fees and commissions regardless of whether you make money or lose money. In fact, in many cases, they profit more when you do things that actually HURT your returns. I fired that broker immediately, and I never worked with a financial advisor again for the next 60 years. That single decision to manage my own money using simple, disciplined principles contributed to me becoming a billionaire. But the lesson here isn't about becoming a billionaire. The lesson is about understanding the system that's been designed to extract money from you and learning how to opt out of it. Before I dive into the math, do me a favor. If financial advisors have ever confused you or made you feel like investing is too complicated, hit that like button, because what I'm about to reveal is going to make you angry. And this message needs to reach more people who are getting robbed every single day. Let me show you exactly how devastating fees are to your wealth, because most people have absolutely no idea how much they're actually paying or what it costs them over time. When you work with a typical financial advisor, there are several ways they extract money from you. First, the assets under management fee, usually 1 to 2% of your total portfolio value annually. That might not sound significant. 1%. 2%, what's the big deal? But here's the mathematics that financial advisors desperately hope you never calculate it. Let's say you have $500 invested and you're paying 1% in fees. That's $5,000 annually. Over 30 years, assuming reasonable market returns at 10% annually, that 1% fee will cost you ultimately $400,000 in lost wealth. $400,000 to have someone manage your money when you could do it yourself better and keep all of that money. But it gets worse, because many advisors also earn commissions on the products they sell you. They'll place you in actively managed mutual funds that pay them kickbacks. They'll sell you insurance products wrapped in investment vehicles that generate massive commissions. They'll recommend annuities that lock up your money and pay them substantial fees. And here's the truly insidious part: all of this is technically legal. It's all disclosed somewhere in fine print that nobody reads. But it's fundamentally corrupt because it creates a system where the advisor profits from giving you advice that may or may not be in your best interest. Let me give you a concrete example. A financial advisor can recommend putting your money in an actively managed mutual fund that charges 1.5% annual fees and pays the advisor a commission. Or they could recommend a low-cost index fund that charges 0.03% annual fees and pays the advisor nothing. Which one do you think they're going to recommend? Obviously the one that makes them money, not the one that's better for you. And they'll justify it with sophisticated sounding language about active management, professional stock picking, beating the market, all of which sounds impressive but is almost never actually delivered. Study after study has shown that over extended time periods, 90% or more of actively managed funds underperform simple, low-cost index funds, especially after you account for fees. But financial advisors keep pushing these high-fee products because that's how they get compensated. This is the core deception. They're not working for you. They're working for themselves. And you're paying for the privilege of getting advice that makes you poorer and them richer. I understood this immediately after calculating what that broker had cost me. And I spent the rest of my life warning people about it. But here's where the story gets even more revealing, because I discovered something that the financial services industry has spent billions of dollars trying to hide. In the early 2000s, researchers conducted a study analyzing the returns of thousands of individual investors who manage their own money versus those who use financial advisors. The results shocked many people, but not me. The individuals who managed their own money generated AAGAR returns on average than those who paid financial advisors. Even though the self-directed investors had no professional training, no credentials, no sophisticated tools, they outperformed the professionals. How is this possible? Two reasons, and I've explained both of them repeatedly throughout my career. First, the self-directed investors weren't paying 1 to 2% annual fees, so they kept more of their returns. That fee drag compounds over time. Every percentage point you pay in fees is a percentage point you're not earning in returns. Over long time periods with compounding, this makes an enormous difference. A 2% fee drag over 30 years will cost you roughly 40% of what your ending wealth would have been. You're giving away almost half of your money to financial middlemen who are providing very little value. Second, and this is crucial, the self-directed investors tended to keep things simple and trade less frequently. They bought index funds or solid dividend, paying stocks, and held them. The investors with financial advisors, on the other hand, were constantly having their portfolios churned, buying and selling, moving money around, generating fees and commissions and taxes, all of which destroyed their returns. The professional advice was worse than no advice at all because the advice was designed to generate fees, not returns. This is the dirty secret of the financial services industry that nobody wants to discuss openly. In most cases, you're better off on your own than paying for advice. I proved this with my own life. After firing that broker in the 1960s, I managed all of my own investments for the next 60 years using simple, disciplined principles. I never worked with a financial advisor again, and I became a billionaire. Now, obviously, I had advantages. I worked closely with Warren Buffett. I had access to opportunities that most people don't have. But the principle is the same for everyone, a simple discipline. Patient investing, without paying fees to middlemen, is how wealth gets built. Not through sophisticated strategies, not through active management, not through financial advisors. Through discipline, patience, and avoiding unnecessary fees. Let me show you a concrete example that makes this absolutely clear. Pause for a second and think about this. How much have you paid in financial advisor fees over your lifetime? Seriously, calculate it right now. Take your advisor's percentage, multiply it by your portfolio value. Multiply that by the number of years you've worked with them. Write that number in the comments below, because when you see it in black and white, you'll understand why this matters so much. I had a friend, I'll call him Dr. Smith to protect his privacy. Dr. Smith is a successful physician. He earns over $400,000 per year. He's been diligently saving and investing for his entire career. And for 20 years, he worked with a well-regarded financial advisor. This advisor charged 1% annually in management fees and had Dr. Smith's money spread across a dozen different actively managed mutual funds, each with its own fees, lots of turnover, lots of active trading. Everything appeared professional. Everything seemed sophisticated. But a few years ago, I looked at Dr. Smith's portfolio and did some calculations. When I add up the 1% advisory fee plus the fees from all the underlying mutual funds plus the trading costs, Dr. Smith was paying approximately 2.3% per year in total fees. 2.3% might not sound catastrophic, but here's what it actually cost him. I compared DAR. Smith's 20-year returns to what he would have gotten if he'd simply put everything in a basic 3 fund portfolio: total stock market index, total international stock market index, and total bond market index with an allocation appropriate for his age. Those index funds charge about 0.1% in fees. Almost nothing. The result, with the financial advisor over 20 years. Without want the advisor, just using simple index funds, $2.9 million. The difference, $1.1 million. Dr. Smith paid his financial advisor for 20 years. And that advisor cost him over own an MLIO dollars and lost wealth. That's not a service. That's robbery. When I showed Dr. Smith this analysis, he was devastated. 20 years of trusting someone, paying them, believing they were helping him. And that person had cost him literally millions of dollars. But here's the thing. Dr. Smith is not unusual. This is happening to millions of people every single day. They're working hard, earning good money, saving diligently, and then giving away a huge percentage of their wealth to financial middlemen who are providing very little value. And the financial services industry has done an incredible job of normalizing this, of making people think it's just the cost of investing, that everyone pays these fees, that it's reasonable. It's not reasonable. It's outrageous. This is the moment where the math becomes crystal clear, where the deception can no longer hide behind complicated language or sophisticated sounding strategies. The numbers don't leave financial advisors, for the vast majority of people, destroy wealth rather than create it. Now let me address what you're probably thinking right now, because this is what everyone says when they hear this. But Charlie, I'm not a professional investor. I don't understand the markets. I don't have time to manage my own money. I need professional help. And here's what I'll tell you. That's exactly what the financial services industry wants you to believe. They've spent billions of dollars on marketing and advertising, convincing you that investing is impossibly complicated, that you need expert help, that attempting to do it yourself is dangerous. But it's not true. Investing is actually very straightforward if you stick to basic principles and avoid doing foolish things. And the irony is that by keeping it simple and avoiding the expensive advice of financial professionals, you'll almost certainly do better than if you pay for their help. Let me prove this to you with some numbers. If you simply put your money in a low-cost S&P 500 index fund and held it for 30 years, you would have outperformed roughly 90% of professional money managers over that time period. And you would have saved hundreds of thousands of dollars in fees that you would have paid to those managers. You didn't need any special knowledge, any sophisticated analysis, any professional advice. You just needed to buy an index fund and not touch it. That's it. But that advice doesn't generate fees for the financial services industry. So they're never going to tell you to do it. Instead, they're going to tell you that you need active management, that you need sophisticated strategies, that you need their expertise. It's all self-serving nonsense designed to extract fees from you. Now let me give you my framework for thinking about when, if ever, you might actually need a financial advisor. Because I'm not saying that nobody should ever use one. I'm saying that 95% of people don't need one and shouldn't pay for one. So when might you actually benefit from professional financial advice? If you have an extremely complex situation, if you own multiple businesses, if you have complicated estate planning needs involving trusts and multiple generations, if you have tax situations that require sophisticated planning across multiple jurisdictions, then yes, you might benefit from hiring specialized professionals. But notice I said specialized professionals, not a general financial advisor. You want a tax attorney for tax planning, an estate planning attorney for estate work, maybe a CFP for specific planning questions, and you want to pay them by the hour for their expertise, not give them a percentage of your assets to manage. For most people, your situation is not complex enough to require any of this. If you're a professional earning a good salary, accumulating savings, investing for retirement, your situation is actually very straightforward, even if it feels complicated to you. You need to do a few basic things. Maximize contributions to tax-advantaged retirement accounts. Invest those contributions in low-cost, diversified index funds. Hold those investments for decades without touching them. Keep 6 months of expensive cash for emergencies, and avoid debt except for a reasonable mortgage on a house. That's it. You don't need a financial advisor to tell you this. You don't need sophisticated strategies or complex products. You need discipline and patience. And those are things you can't outsource to someone else anyway. Let me tell you what I did with my own money over the years, because I think it illustrates the principles I'm teaching you. After I fired that broker in the 1960s, I never worked with a financial advisor again. Never. I managed all of my own investments for the next 60 years, and I became a billionaire. Now, obviously, I had advantages. I worked closely with Warren. I had access to opportunities that most people don't have. I'm not suggesting that you can replicate my exact results, but the principle is the same. I kept things simple. I invested in businesses I understood. I held for very long periods. I didn't trade frequently. I didn't try to time the market. I didn't pay fees to middlemen. Simple, disciplined, patient investing, that's what works. And you can do that without paying anyone a percentage of your wealth. Let me give you a concrete example that makes this tangible. Let's say you're 40 years old, you have $200,000 saved, you're earning $150,000 a year, and you can save $30,000 annually going forward. You go to a financial advisor and they recommend a portfolio of actively managed funds, charge you 1% annual management fee, and over the next 25 years until you're 65. Let's say you accumulate $2 million. That sounds pretty good. But here's what happens if you do it yourself. You put that same money in low-cost index funds charging 0.1% fees instead of 1%. The money compounds at the same market rate, but you're keeping an extra 0.9% per year by avoiding the advisor fee. Over 25 years, that difference means you end up with about $2.4 million instead of $2 million. You just made an extra $400,000 by doing it yourself. $400,000 that a financial advisor would have extracted from you in fees for giving you advice that you didn't need, and that probably didn't help you anyway. But it's even worse than that when you consider what financial advisors typically do with your money, because they're not just charging you fees. They're often putting you in investments that themselves charge high fees. So you're paying a 1% advisory fee on top of 1 to 2% mutual fund fees. And now you're losing 2 to 3% per year to fees. That's absolutely devastating to wealth accumulation. I cannot stress this enough. Fees are the silent killer of wealth. Every percentage point you pay in fees is a percentage point you're not earning in returns. Over long time periods with compounding, this makes an enormous difference. A 2% fee drag over 30 years will cost you roughly 40% of what your ending wealth would have been. You're giving away almost half of your money to financial middlemen who are providing very little value. It's robbery, legalized robbery, but robbery nonetheless. And the financial services industry has done an incredible job of normalizing this, of making people think it's just the cost of investing, that everyone pays these fees, that it's reasonable. It's not reasonable. It's outrageous, and you should be angry about it. Now let me talk about the specific lies that financial advisors tell to justify their fees, because understanding these lies will help you resist them when you hear them. Lie number 1, you need active management to beat the market. This is the most common justification for high fees. They'll tell you that their professional stock picking, their research capabilities, their sophisticated strategies can generate returns that beat simple index investing, and therefore their fees are worth it. But the data overwhelmingly shows this is false. Over any meaningful time period, the vast majority of active managers fail to beat the market, especially after fees. Even among the small percentage that do beat the market in any given year, very few can do it consistently over multiple years. It's basically random. And the ones that do succeed are almost impossible to identify in advance. So paying for active management is paying for a service that statistically doesn't work. It's like going to a doctor who has a 5% success rate and paying premium prices for their services. You wouldn't do it in medicine, but people do it with their investments every day because they've been deceived. Line number 2, diversification, requires sophisticated portfolio construction. Financial advisors love to talk about asset allocation, about balancing different asset classes, about correlation coefficients and efficient frontiers and all this complicated sounding stuff. And then they'll tell you that creating a properly diversified portfolio requires professional expertise. This is nonsense. Diversification is important, but achieving adequate diversification is trivially easy. You can buy a single total stock market index fund, and you immediately own a piece of thousands of companies across all sectors and sizes. That's diversified. If you want to add some bonds, buy a total bond market index fund. Now you're diversified across stocks and bonds. Congratulations, you just built a properly diversified portfolio in about 5 minutes with 2 funds. You didn't need a financial advisor. You didn't need sophisticated analysis. You didn't need to pay ongoing fees. But that simple solution doesn't generate revenue for the financial services industry, so they pretend it's not adequate and that you need something more complex that they can charge you for. Line number 3, market timing and tactical allocation can protect you from losses. When markets get volatile, financial advisors like to talk about how they're actively managing your portfolio, moving to defensive positions, reducing equity exposure, protecting your downside. It sounds good. It makes you feel like you're getting value for your fees, like they're doing something to earn their keep. But study after study has shown that market timing doesn't work consistently. Nobody can reliably predict when markets will go up or down. The advisors who successfully navigate one downturn fail to navigate the next one. It's just luck disguised as skill. And the costs of this active trading, the transaction costs, the tax consequences, the fees, almost always outweigh any benefit from the occasional correct timing decision. You're better off doing nothing, just holding through volatility, than paying someone to actively manage your portfolio in and out of the market. Line number 4, you need guidance to avoid emotional mistakes. This one is particularly insidious because it contains a grain of truth, which makes it more believable. It's true that individual investors often make emotional mistakes. They panic and sell during market crashes. They get greedy and buy at market peaks. They chase performance, buying whatever went up the most recently. These are real problems. And financial advisors will tell you that they provide value by preventing these emotional mistakes, by being the steady hand that keeps you disciplined. But here's the reality: financial advisors don't actually prevent emotional mistakes. They just shift them. Instead of panicking about the market, clients panic about whether they have the right advisor. Instead of chasing performance, they chase advisors with the best recent track records. And in many cases, financial advisors themselves make emotional mistakes with their clients' money. They're human too. They're subject to the same biases and emotions. The real solution to emotional investing mistakes is education and discipline, not paying someone else to make decisions for you. If you understand basic investment principles, if you've committed to a long-term strategy, if you've accepted that volatility is normal and temporary, you don't need to pay someone to keep you from panicking. You just need to stick to your plan. Let me tell you about what happened during the 2008 financial crisis, because it perfectly illustrates the lie about financial advisors protecting you from emotional mistakes. I knew dozens of people who had financial advisors managing their money, and during the worst of the crisis in late 2008, early 2009, when the market was down over 50%, you know what most of those financial advisors recommended? They recommended selling, moving to cash, protecting what was left. And their clients did. They sold near the bottom, locked in huge losses, and then they missed the subsequent recovery. Meanwhile, I knew other people who didn't have financial advisors, who just held their index funds through the crash because they didn't know any better or because they trusted that markets eventually recover. And those people, the ones without professional advice, ended up much better off because they held through the crash and participated in the recovery. The professional advice, which people paid for and trusted, was worse than doing nothing. It destroyed wealth. This happens over and over again, but people keep trusting financial advisors because the industry has convinced them that they need professional help. Now let me give you my alternative framework. Instead of paying a financial advisor 1% of your assets every year for the rest of your life, here's what you should do. First, educate yourself on basic investment principles. You don't need to become an expert. You just need to understand a few fundamental concepts: what stocks and bonds are, how they generate returns, why diversification matters, why fees matter, how compounding works, why time in the market beats timing the market. You can learn all of this in a few weeks of reading. I'd recommend reading a few books. The Little Book of Common Sense Investing by Jack Bogle, A Random Walk Down Wall Street by Burton Malkiel, and yes, some of what Warren and I have written about investing over the years. These aren't complicated books. They're written for ordinary people, and they'll teach you everything you need to know to invest successfully on your own. Second, keep your investment strategy simple. I cannot emphasize this enough. Simple beats complex almost every time. Buy low-cost index funds that track broad market indices. If you want to keep it incredibly simple, just buy a target date retirement fund from Vanguard or Fidelity that matches your expected retirement year. These funds automatically adjust your asset allocation from stocks to bonds as you age, and they charge very low fees, typically around 0.1% or less. That's it. You're done. You don't need anything more complicated. You don't need individual stocks unless you really enjoy researching companies and understand the risks. You don't need real estate investment trusts or commodities or international small cap value funds or any of the other complicated things financial advisors will try to sell you. Just broad market index funds held for decades with consistent contributions from your income. This strategy is boring. It's not exciting. It won't give you interesting stories to tell at parties, but it works. It works better than almost anything else you could do, and it costs almost nothing. Third, automate everything so you don't have to think about it and you don't have to rely on discipline. Set up automatic contributions from every paycheck into your retirement accounts. Set up automatic investment of those contributions into your chosen index funds. Set up automatic rebalancing once a year if you have multiple funds. The less you have to think about your investments, the less you have to actively manage them, the better you'll do. Because every time you think about your investments, every time you check the balance, every time you read a news story about the market, you create an opportunity to make an emotional mistake. Automate it, forget about it, and let compound interest do its work over decades. This is what wealthy people actually do. By the way, they set up systems that work automatically, and then they focus their time and energy on earning more money, or building businesses, or doing things they enjoy, not obsessing over their investment portfolios. Fourth, if you have specific questions or need help with something particular, hire a fee-only financial planner to answer those specific questions. Pay them by the hour, get your answer, and move on. Don't give them ongoing control of your money. Don't pay them a percentage of your assets. Don't get locked into an ongoing advisory relationship. Just pay for specific advice when you need it and manage everything else yourself. This might cost you a few $100s a year instead of thousands or tens of thousands in advisory fees. The savings are enormous, and the advice is often better because the planner has no incentive to recommend complex products or strategies that generate ongoing fees. They just answer your question. You pay them for their time, and that's it. This is how you should think about professional financial advice, as something you buy when you need it, not as an ongoing service that you pay for every year regardless of whether you're getting any value. Now let me address the question I know some of you are asking. Charlie, if what you're saying is true, why does the financial advisory industry exist? If they're not providing value, why do so many smart people use financial advisors? And the answer is a combination of brilliant marketing, regulatory capture, and human psychology. The financial services industry spends billions of dollars per year on advertising and marketing to convince you that investing is complicated and scary and that you need their help. They sponsor studies that show the value of financial advice. They lobby for regulations that make it harder for individuals to access certain investments without going through advisors. They build an entire infrastructure of credentials and certifications and professional associations that give the appearance of expertise and legitimacy. And they exploit basic human psychology, particularly the desire to outsource difficult decisions and the willingness to pay for peace of mind, even if that peace of mind is not actually justified by better outcomes. People want to believe that there's someone smart taking care of their money, someone who knows more than them, someone who's looking out for their interests. That desire is so strong that people will pay enormous fees for it, even when the evidence shows that they're not getting value. It's a brilliant business model for the advisors, terrible for the clients. And here's the really perverse part: the worse the economy does, the more valuable financial advisors appear, even though they can't actually protect you from economic downturns. When markets are volatile, when people are scared, that's when they're most likely to pay for advice, to hire a financial advisor to buy that peace of mind. But that's exactly when you're most likely to get bad advice, because advisors are human too, and they're scared too, and they're likely to make the same emotional mistakes that their clients would make, except now the client is paying for the privilege of having someone else make those mistakes with their money. The whole thing is absurd when you step back and look at it objectively, but people are so conditioned to believe that they need professional help that they don't question it. So what should you do if you're currently working with a financial advisor? First, don't panic, don't make any immediate changes, but do start asking questions. Ask your advisor exactly how they're compensated. Do they charge a percentage of assets? Do they receive commissions on products they recommend? Are there any conflicts of interest in how they're paid? If they're not completely transparent about this, that's a red flag. Second, ask them to justify their fees. What specific value are they providing that justifies 1% or more of your assets every year? What returns have they generated for you after fees compared to a simple index fund? If they can't give you clear, quantifiable answers, that's another red flag. Third, calculate exactly how much you're paying in total fees. Add up the advisory fee, the underlying fund fees, any trading costs, any other charges. Most people have no idea how much they're actually paying because it's intentionally obscured, but you need to know. And once you know, you need to ask yourself whether that amount of money is justified by the value you're receiving. And here's the hard truth for most people. The answer is going to be no. The fees are not justified. You're paying for something you don't need. And if that's the case, you need to make a change. You need to fire your financial advisor, move your money to a low-cost brokerage like Vanguard or Fidelity, invest in simple index funds, and take control of your own financial future. Is this scary? Yes. And will you feel uncomfortable at first? Absolutely. Will you second-guess yourself? Probably. But I'm telling you, as someone who's been investing for over 70 years, who's accumulated billions of dollars in wealth, who's seen every possible approach to investing over multiple generations, this is the right move for the vast majority of people. You don't need a financial advisor. You need education, discipline, and a simple low-cost investment strategy. That's it. Hit that subscribe button right now because I'm exposing more of these industry lies every week. And watch the video I'm putting on screen next where I show you the exact index funds you should buy and the precise allocation you need for your age. And do me one more favor. Forward this video to any friend who's paying advisor fees. They'll thank you and 400,000 richer in 30 years. Let me end with this. The biggest lie financial advisors tell you is not really about investing at all. It's a lie about who you are. They tell you either explicitly or implicitly that you're not capable of managing your own money, that you're not smart enough, not educated enough, not disciplined enough, that you need them because you can't do it yourself. And this lie is particularly effective because it taps into people's insecurities, their fear of making mistakes, their imposter syndrome. But it's not true. You are capable of managing your own money. You don't need special expertise or credentials or insider knowledge. You just need to learn some basic principles. Keep things simple, be patient, and avoid paying unnecessary fees to middlemen. If you're smart enough to earn a good living at your profession, you're smart enough to invest your own money. Don't let the financial services industry convince you otherwise. Don't let them extract decades of fees from you for services you don't need. Take control of your money. Educate yourself. Keep it simple. And you'll end up far wealthier than if you pay someone else to do it for you. That's the truth they don't want you to know. But now you know it. What you do with this knowledge is up to you.